Business Morning. Today we're looking at the capital market and money market performance at half year, and I have two financial analysts. I have Bumi Ashaolu from FBN Capital. I also have Jimmy Ogbobine, Investment Bank, that's BGL. He's also a financial analyst, and we're looking at both the capital market and the money market at half year. Good morning, gentlemen. Thank you for being here.
Thank you very much.
Bumi, let me start with you. Capital market, specifically the stock markets. Presently, we've recorded, or the market has recorded, a year-to-date performance of 13%. Now, in the last couple of weeks, we've had this rally that has just been able to sustain itself. And of course, it's not too far-fetched. It's most likely the earnings season, the second quarter earnings season, that has been able to sustain this rally. But looking at from where we started in January, around the 20,000 points or so, we're down to up at 23,000 points. There were so many projections, forecasts, which were mostly negative, not too bright, because of illiquidity and some of the issues in the market. But in your own perspective, how would you describe or rate the market at half year?
Yeah, market's up 13%, thereabout. At the start of the year, we had an upside of about 13-14%, so to 23,500. That level was reached about, I think, last week. I think it's worth breaking down the performance of the index into two parts. So you look at the bank's performance and you look at the non-financials. The banks came into 2012, I think, with probably the most favorable environment since 2007, fundamentally speaking. So let's strip out all the excesses. So there was a reason why the bank should have done quite well. Now, depending on which side of the fence you sit on, you may have a conservative view about whether the banks would actually do as much as we were projecting at the time. But if you took a little bit more risk on, you would have done quite well. So if you look at the best performers of the major stocks on the NSE, you'd find that the banks led the way easily. So you find UBA, Access, likes of Diamond. So it's not a coincidence that these banks show up at the top of the table. You'd find some non-financials there as well, but they start on maybe number 5, 6, 7. But the banks definitely are the main drivers of what you see for the NSE.
That was a key focus for especially institutional investors. The fact that well, yes, let's just focus on the banks now, because there was so much this momentum that built up just before. After the first quarter, just ahead of the second quarter earnings. So for you, the key driver so far has been the bank earnings.
Yeah, because if you look at the change in their return on equity, it's been quite phenomenal. So sometimes it's been helped by the fact that coming to 2012, they booked quite a lot of provisions. So the base was easy. When you're coming from a loss position in 2011 and annualized by the middle of the year, you've done something like 20-25%. It's pretty special for Nigerian banks. So it's becoming difficult for even the most conservative people or investors to ignore the performance of the banks. So I think that's what's led to the performance we've seen so far.
Okay, but we'll come back to the banks. Let's come to you, Jimmy. Now, when we talk about capital markets, especially stock markets, bringing apart from investors' confidence, there's always that issue of liquidity. You talk to an average stockbroker, an informed investor, they say there's no liquidity in the market. Money market activities are hurting. When we have T-bills or treasury bills with very attractive interest rates, what's the incentive to put money, or not to put money in the money markets? What is your take on that?
First and foremost, when you speak with stockbrokers right now, and they still complain of liquidity, then you've got to look at you've got to ask yourself who's actually investing in the capital markets to drive it. According to the NSE Director General, 80% of trades on the market are being done by foreign portfolio investors. So if 80% of these people who are driving the market actually do have the liquidity, then sorry to stockbrokers, they're actually not players right now. Now, with foreign portfolio investors driving such huge volumes in your market, what that happens is it increases volatility. So hot money, so much hot money in the system, and they ride on the back of volatility. Now, outside the stockbrokers, the second largest block of institutional investors who can play in the capital market will probably be pension fund assets. And old regulations, old asset class rules allow them to put as much as 25% of their assets under management in the capital market, in equities. But many of them, because of opportunities in the money market and government fixed income markets, have compressed this to as low as 8-9%. Some are doing 7%. And the best performing ones among the PFAs, for instance, are all in fixed income and in the money market. So like I said, sorry, stockbrokers at this point in time are not really players. Portfolio.
Sorry to butt in, Jimmy, because really, it was really not just the stockbrokers who are of this opinion. Some financial analysts that I have spoken to that have come on this program keep talking about the fact that there's no liquidity. We have to look at just the monetary arm of things. As you know, T-bills interest rates are very high. All the money is in the money. So you are saying that that's the activities of the money markets or the monetary authorities has in no way.
Now I'll tell you how it has.
Affected the camp.
Stockbrokers, for instance,
Okay.
Apart from routing trades through them, many of them actually did have large portfolios, in proprietary portfolios they could play on. So right now, the money market rates and the whole crunch in the market has affected proprietary portfolio positions. So many have sold down for day-to-day survival. Many have sold them just to see the next day, just to keep going concern status, in place. So in that instance, they cry about liquidity. But like I said, 80% of your market is by foreign portfolio investors who are looking at bargain hunting in your market, who are looking at blue chip selling at great discounts, and who've got this liquidity. The pension fund assets, who can do as much as 25% of over a 2 trillion asset war chest, do not actually appreciate the big discounts on blue chips right now in the market. And many of them are still sitting on the fence. He talked about opportunities in the bank, but just a few of them were able to take these bets because they looked at it that, look, at the end of the day, all these upsides in the market may not materialize, in the capital market may not materialize, but they're sure of one thing, they're sure of fixed returns on fixed income instruments like treasury bills, money market rates.
Talking about fixed income, Bumi, I see you smiling at me. Let's look at the bond market. Okay, I would come to that. Let me first of all just look at some other sectors of the market. We talked about the banks, the fact that they have been the key driver. Of course, we've had that clean up in the banking sector. The balance sheets are healthier. They can report numbers that investors can actually trust this time around and not thinking about the fact that perhaps the books were actually cooked. The defensive sector of the market, consumer goods, there was a time when there was actually a lot of focus, on the Nestle's, the other big, guys there, but it looks like now shine has been taken away from them. Haven't they done so well this year?
Well, I mean, it's all relative. As we know, the banks have done pretty well. The non-financials, yes, they're not doing as well as they would have in the past. I think one very quick back of the envelope way of looking at the non-financials, if you are a major multinational, you probably be in a duopoly or oligopoly in Nigeria. So 2 or 3 of you dominate the market you're in, and typically they don't really go for price wars. So there is a general sort of unwritten rule where you can easily grow your top line by 20% every year. So your unit growth is about 7 to 10%, and you slap on something like a 10% price increase. So you grow your top line by 20%. And most of the time, their margins are stable, so they can grow their earnings by about 20% on year on average. And if you look at Nigerian breweries, Guinness, Nestle over the last 5 years, you find that they're the sort of numbers you get. But this year, the reduction in fuel subsidies actually hasn't really helped. Then that's added to inflation, hiking electricity tariffs, imported inflation via increased prices of wheat. All those things have contributed to reducing the magnitude of the growth you normally see for these guys. Now, they're still growing, but when a Nestle is telling you that for the full year this year we'll grow our earnings by less than 1%, well, I mean, it's Nestle. I mean, Nestle is a blue chip, benchmark in the consumer space.
Investors would expect much better.
And if you look at the Q1 results, it looks extremely strong, but that's because there was a bit of a pull-in from Q2. So if Nestle is talking about a sort of flattish environment, yes, the results haven't been disastrous. They've been okay. But in the past, these companies will grow much faster.
You say okay. I've heard the words, good, impressive, robust, sharply higher phrases referring to the second quarter results. Not of the banks, industrials, Dangote Cement, Lafarge Wapco, CCN, some of the top industrials on the stock.
Yeah, I mean, if you compare what the market was expecting, then I'm not sure whether you'd be able to put them in that sort of. I don't think it's justifiable to put them in that sort of language. When you've doubled your capacity, well, yeah, you're going to grow your earnings a lot, but it depends on what the market was expecting or what you'd said you were going to do. If you come in below that, then you've not done amazingly as well as you should. So the year-on-year growth look amazing, but relative to what people are expecting or what you've actually guided the market on, you're not doing as well as you could have. And the number's not bad, don't get me wrong.